All right, this video builds off of the previous video, and the previous video was a California or a married couple in California that took the standard deduction. So this one is going to be if they itemize their deductions, because itemized versus standard, you just take the higher amount because it's a deduction. And so we're going to assume, so everything else is equal. We're going to add that they have a mortgage that they paid interest about $30,000, and they also pay taxes of $3,500. Sometimes the real estate tax is on the Form 1098, and sometimes you have to ask the client, and sometimes you have to go to the county website to determine how much taxes were paid in the tax year that you're looking at. And then we just assume that there's a $500 church donation. Sometimes clients just give this to you like this. Sometimes they give you a form. Of course, the better documentation would be in a form from the church. But some people give money to the church and don't get a tax form. And entirely up to you if you want to allow that, or if you have them or need them to request it from the church before you'll allow them to take that deduction. So all things equal, $30,000 mortgage interest, $3,500 in taxes, $500 in church donations. I input that into my 1040 reconciliation, which is right here, $3,500 in real estate taxes, $30,000 in mortgage interest, and $500 in church donations. As you can see, there's also state income taxes paid, which is the California taxes withheld, plus the California state disability amounts, which totals up to $9,150, plus the $3,500 is $12,650. And for federal, the $10,000 is limited, and so you can't take more than $10,000 of taxes. And so their itemized deductions is $40,500 versus the standard deduction of $29,200. So therefore, we take the higher amount. So that flows here, and therefore it brings down their taxable income to $109,575, which is roughly about an additional about $10,000 less in taxable income. This number is not right, but so this is the tax that they had before when it was the standard deduction. So after this, we're gonna go into the tax software and input this stuff in. Itemized deductions. So we're going to input the actual 1098. What was it? What did I put? 9912. Yes. So made up this fake bank. Computer remembers it. Mortgage interest, we put 30,000, 750,000. It's not a huge. So this amount isn't really that big. Well, it could be a big deal depending on when you got your mortgage, because mortgage interest is limited if you have over $750,000. If you got the loan after a certain year, before a certain year, it was like $1 million. So don't want to go into the details of that. I usually just enter in this information if I can, unless it affects my taxes in terms of it doesn't give me the correct number. I've been doing this a long time, so I kind of know what the number should be. Assume that it was 2024, and this is where you put the taxes, if there is. Some 1098s have it, some don't. We'll say it's a primary residence. And I think that should be good for that. And then $500 right here. And I think that's all we're changing. And so let's see what it looks like on the first page. $150,000, $75 in interest income. There's the $40,500 of itemized deductions versus the standard deduction. 109,575. Taxes are lower because of the additional itemized deduction amounts. 14,213. We assume they withheld $15,000, so there's an overpayment of $787. So let's check. So 14,213. Average tax rates 13%. Refund of $787. And let's see what California should be. Should be the same. California, their standard, actually their itemized deduction is different because they don't factor in their state income taxes paid. And so therefore, this amount is just going to be the $30,000 of mortgage interest, $500 of church donations, plus the $3,500 in real estate taxes. So that's $34,000. California does not allow you to take the state income taxes as a deduction, which makes sense. So that's California. And so their new taxable income is $124,375. And I don't know or it should be $124,375. Let's see if that's right. Yep, $124,375. Taxes $48.70. The exemption credits $298, which was $149 times 2. So this is the total tax, $45.72. We assume $700 was withheld, but we also assume that they didn't have health insurance, so they're hit with this penalty, and therefore they owe $82 in taxes. So let's go back. Oops, what was the number? 4870. 4870. 4572. $82 refund. Did I read that wrong? Oh yeah, so I read it wrong. So it's $82 of overpay tax. I just assumed since it didn't have a negative, it was $82 that they owed. So we get $82 refund. And also, if they did have health insurance, they should have gotten $29.28 back. That's for California. This is itemized deductions. And so for Arizona, it should be similar to federal other than the tax amount. $150,000, $75. And this is separate. I'm just assuming if they were an Arizona resident, this is what it should look like from the state perspective. $150,000, $75, $40,000 of standard deduction, similar to the same as federal. $109,575 for taxable income, and their tax rate is 2.5%. $27.39 is what they would owe minus whatever tax they were withheld. So that is. So we'll go back to California. This is what it's supposed to be. This was married California residents with itemized deductions to kind of show the difference between standard and itemized. Let me know if you have any questions. And the next video is going to be building off of this, and they're going to have 2 kids under the age of, I think 6 is what I put onto it. But anyways, they qualify for the child tax credit.